Hey there, future investors. Welcome back to our channel where we demystify the world of stocks and options for you. Today, we're diving into the thrilling world of option strike prices. But don't worry, we'll keep it real simple, engaging, and most importantly, easy to understand. So let's embark on this journey together and unravel the mysteries of options trading. Imagine you're at an auction, but instead of bidding on antiques, you're securing a special price for a stock. That's your strike price. In the realm of options, this price is the heart of the deal. It's the agreed upon price at which you can buy or sell a stock in the future. Calls and puts play by these rules, either giving you the right to buy or sell at this price. Let's talk about moneyness, a fancy term to describe where the strike price stands in relation to the market price. If your strike is lower than the market price for a call option, congratulations, you're in the money or ITM. This means you can buy the stock for less than it's selling for, a real bargain. For puts, it's the reverse. Out of the money or OTM means the market hasn't moved in your favor, but hey, there's always a chance. Now, let's spice things up by adding delta into our moneyness mix. Think of delta as the heartbeat of an options price movement. It tells us how much the price of an option will dance or change with a $1 move in the stock. For in the money ITM options, the heartbeat is strong. They have a higher delta, meaning they move more in sync with the stock. Yes, in the money options may cost you more upfront compared to out of the money options, but here's the kicker. You get more bang for your buck because their value zooms faster than an OTM option as the stock price moves. Imagine you're eyeing options for future tech, which is trading at $100. You have two choices, an in-the-money call option with a strike price of $90, boasting a delta of 0.7, or an out-of-the-money call option with a strike price of $110 with a delta of 0.3. If future tech stock jumps to 101, here's what happens. The in-the-money option price will leap by 70 cents thanks to its delta. The out-of-the-money option, more like a cautious hop, will only increase by 30 cents. So while the in-the-money option costs more initially, its value aligns more closely with the stock's movements, offering a speedier ride on your investment dollar. This delta-driven dynamic is crucial for understanding why an in-the-money option, despite its higher price tag, can be a more potent choice for investors looking to closely mirror the stock's performance. It's all about finding the right balance between risk and reward, speed and cost. So there you have it. That's the essence of moneyness and the power of delta in the world of options. Whether you choose the fast-paced thrill of in-the-money options or the hopeful watch from the sidelines with out-of-the-money options, understanding these concepts is your first step towards savvy investing. Remember these pointers. Number one, the strike price is your golden ticket to buy or sell a stock at a specific price. Number two, in the money and out of the money are not just investor lingo, they're your indicators of potential profit. Number three, at the money means the strike price and the market price are playing a tight game of tag. Number four, the higher the delta, the faster the option price will move. When buying options, I normally like about a 0.7 delta. And in case you're wondering, when Nancy Pelosi buys options, they're typically about 1 year out and they're a very high delta as well. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Let's say Tech Innovators is trading at $100. If you have a call option with a strike price of $90, you're sitting pretty with an in-the-money option. But if your strike price was $110, you're hoping for a rally since you're currently out of the money. Options are a bit like a seesaw. The closer your strike price is to the market price, the more valuable your option might be. Time and volatility are the playground bullies here, constantly shaking things up. Let's cover an example where we explore the outcomes of two very strategic choices in the options market. Meet our contenders, Investor A, who prefers playing it somewhat safe, and Investor B, who likes to walk on the wild side. Investor A's safe bet. Investor A picks a call option for Gadget World, currently trading at $95, with a strike price of $100, betting the stock will rise. The option has a delta of 0.5, meaning for every $1 increase in the stock, the option price goes up by 50 cents. Investor B's bold move. On the flip side, Investor B goes bold, choosing a call option with a strike price of $120. This option has a lower delta of 0.2, making its price less sensitive to stock price movements, but offering higher returns if the stock makes a significant jump. As the dust settles, Gadget World stock soars to $115 thanks to a groundbreaking product launch. Investor A's option is now in the money, gaining significant value and providing a comfortable profit from their investment. However, Investor B's option, despite the stock's impressive gain, remains out of the money, with the stock not reaching the ambitious $120 strike price before expiration. Investor B's option expires worthless, marking a loss on their daring bet. Let's go over the lessons learned. This example teaches us the delicate balance between risk and potential reward in the options market. Investor A's cautious approach paid off with a solid win, while Investor B's high-risk gamble didn't cross the finish line this time. Each strategy carries its own set of risks and opportunities, emphasizing the importance of aligning your options trading with your risk tolerance and market outlook. And that, my friends, is the essence of option strike prices. Remember, options trading is a journey filled with learning and excitement. Today's lesson is just the beginning. Stay tuned for our next adventure where we'll explore option expiration dates. Together, we'll ensure you're well on your way to becoming a savvy investor. Keep it real, and I'll see you in the next video.